Hey everyone, and welcome back. Today, we're talking about a technology that's reshaping global finance, yet many people still find confusing: Bitcoin. We're going to break down how it started, what it actually is, tackle the biggest criticisms, and look at the exciting future, including a major development from Jack Mallers and his company, Strike. To understand Bitcoin, we first have to understand the foundational problem it was designed to solve. Jack Mallers calls this the vicious fiat cycle. The core issue is fiat currency, the regular dollars, euros, or yen issued by governments. When the US government and the Federal Reserve print more dollars, those dollars become worth less. This process makes the life we want, owning a house, going to college, further away, unachievable, and not affordable. This scary reality created by inflation forces almost everyone into debt. Student loans, credit cards, mortgages, and buy now, pay later schemes. The results are staggering. Households in the US are now over $18 trillion in debt, and credit card debt has passed $1 trillion. The US dollar, since the Federal Reserve launched it a little over 100 years ago, has lost 97% of its purchasing power. It's important to note who benefits from this. Historically, once the US dollar divorced from the gold standard in 1971, printing money really benefited the top 1%. The wealthy have gotten much richer, while the income for the rest of us, the bottom 90%, has either stagnated or is declining. For example, before we went off the gold standard, it took just a few years to save for a house. Now, it takes a decade. As Henry Ford supposedly noted, if people truly understood our banking system, they would adopt Bitcoin before tomorrow morning. The solution to the vicious fiat cycle is Bitcoin, the money that nobody can print. The idea for Bitcoin arrived on Halloween 2008, when someone using the name Satoshi Nakamoto posted a white paper online. In 2009, Bitcoin was born. Satoshi's goal was to create money whose value couldn't be manipulated by a central authority. The system is built on mathematics, which governments cannot change. They cannot point their guns at the mathematical problem Bitcoin is based on, just as 2 plus 2 will always equal 4. Satoshi's creation was a new electronic cash system that's fully peer-to-peer with no trusted third party. Bitcoin started small. The first widely acknowledged transaction for a tangible good occurred in the spring of 2010, when a man in Florida offered 10,000 Bitcoins for anyone who would buy him pizza. Someone in London accepted, ordering him 2 pizzas. The project began to garner serious attention in 2011, after WikiLeaks began accepting Bitcoin donations, following blocks put in place by major financial institutions like Visa and PayPal. In one of his last known posts, Satoshi expressed concern that this attention had kicked the hornet's nest. Shortly thereafter, Satoshi disappeared from online forums and was never heard from again. So what exactly is Bitcoin? Think of it as a revolutionary technology that allows you to put a bank in your pocket. Bitcoin is a peer-to-peer system, meaning there is no central authority issuing the currency. Instead, it's an open accounting system, where thousands of computers worldwide track the ownership of digital tokens called Bitcoins. When you send Bitcoin, the transaction is broadcast to the network, verified, and recorded in a public ledger called the blockchain. This ledger contains a record of every transaction ever made since the system began, and it is shared and maintained across the network, meaning everyone keeps the books, so to speak. The supply of Bitcoin is fixed. The system is programmed so that only 21 million Bitcoins will ever exist. This predetermined scarcity makes Bitcoin function much like digital gold. Bitcoin is unique because it's the first digital product that is also truly scarce. When we look at the report card for desirable properties of money, Bitcoin scores straight A's. It is fungible, portable, durable, divisible, and, crucially, nobody can print it. Despite its revolutionary nature, Bitcoin faces fierce criticism. First, the issue of risk and volatility. Professional economists often argue that Bitcoin is too risky, but the data tells a different story. As Bitcoin matures, its volatility goes down. Today, Bitcoin's volatility is comparable to, or even less volatile than, major growth stocks like Tesla. This fact contrasts sharply with early Bitcoin lending markets, which often charged outrageous rates, sometimes 15% or 20% a year, for Bitcoin collateralized loans. These high costs didn't align with Bitcoin's actual risk profile, which is now no more risky than holding a Tesla stock. Second, the criticism of no cash flow. Critics, such as Peter Schiff, argue that Bitcoin has no intrinsic value, earnings, or dividends. Jack Mallers calls this argument stupid. The truth is, everything you own can generate cash flow. Cash flow comes in two forms: issuer cash flow, like interest payments from a government bond, and cash generated when you sell an asset, such as selling a house you own. If you dollar cost average, buying just $100 of Bitcoin a week over 4 years, your $20,000 investment might be worth over $60,000. If you want cash, you can simply sell it for $60,000. In that sense, Bitcoin generates returns through appreciation rather than traditional dividends. However, the real difficulty isn't generating cash flow, but solving what Mallers calls the HODLers dilemma. The term HODL, which means hold on for dear life, comes from a famously misspelled 2013 forum post by an intoxicated Bitcoiner who decided to hold because he was a bad trader. The meme is powerful. If you own the scarcest money in human history, the best strategy is often just to save it and never sell. But here is the dilemma. Money is a means, not an end. Every Bitcoiner eventually faces a choice. They have to sell their scarce asset to afford life, to buy a house, start a business, or handle a medical emergency. Throughout history, the solution to needing cash without selling a valuable asset was simple: borrowing against scarcity. Imagine a great-great-grandfather who owned prime Manhattan land centuries ago. He became a legend not by selling it, but by borrowing against it. He borrowed against it to finance growth. Even today, Elon Musk borrows against his Tesla shares. The Dutch and British East India Companies pioneered this concept in the 1600s, collateralizing their desirable assets to perpetuate their growth. New York City was built entirely on this principle: borrowing against land and buildings, rather than selling the scarce asset. Bitcoin is fundamentally the best collateral known to man. Compared to traditional collateral like a house, Bitcoin is faster, more portable, more divisible, and easier to custody. Its market operates 24/7, is global, and liquid in every currency. If you're a lender and need to liquidate collateral quickly, it's much easier to sell a fraction of Bitcoin than the fourth bedroom in an attic. Recognizing this, Jack Mallers and Strike focused on solving the HODLers dilemma, ensuring Bitcoiners don't have to sell their sats, fractions of Bitcoin. About a month before this speech, Strike launched its Bitcoin lending product. Strike's offering is designed to be responsible and accessible. 1. No rehypothecation. When you deposit Bitcoin as collateral with Strike, it does not move. It sits securely in a Bitcoin address for the duration of the loan, with no yield, no gimmicks, no nothing. 2. Low, single-digit rates. Strike aims to be the first financial institution of its scale to officially give out loans for a single-digit interest rate. This is revolutionary compared to the historical 15% or 20% rates previously seen in the crypto space. 3. Accessibility and speed. Loans start as low as $10,000. Importantly, there are no credit checks. The Bitcoin collateral is what matters. Customers can get cash easily and quickly, sometimes within 30 minutes, to make a home down payment or pay bills. Strike itself holds 1,500 Bitcoin in its treasury, and even uses its own lending product. Mallers calls this putting my money where my mouth is. By allowing people to responsibly borrow fiat currency while keeping their Bitcoin off the market, this accelerates the death of this awful thing and increases Bitcoin's utility for individuals and businesses. Mallers himself has not sold a single sat since the product launched. Bitcoin has matured into a $2 trillion asset class. Now, thanks to innovations like those from Strike, Bitcoiners can responsibly tap into their wealth without being forced to sell their core savings. Mallers offers a serious warning. Debt must be handled carefully. Like fire, it can warm a home, but if you go too crazy, you'll burn your house down. But if we continue to push and mature this asset class, we ensure that hodlers do not have to face the dilemma. The goal is simple. You get to live your life, but with Bitcoin, You get to live a better one. Now, we want to hear from you. Let us know what you think in the comments below. If you could borrow against your Bitcoin at a single-digit interest rate right now, what life goal would you use that cash for? Starting a business, buying a house, or something else? And the US dollar has lost 97% of its purchasing power since the Federal Reserve launched it. What percentage of your savings do you feel comfortable keeping in fiat currency versus Bitcoin? Thank you for watching. Don't forget to like and subscribe for more.